What's up, crypto crew? Welcome back to Bitcoin Bulletin, where we break down the biggest stories in digital assets. First up, get this. Pantera Capital founder Dan Morehead is not holding back, forecasting Bitcoin to hit a mind-blowing $750,000 in the next 5 years. But that's not all. He's also launching a new Solana-focused Treasury company aimed at Nasdaq listing, promising direct exposure to SOL with juicy staking yields. This is huge for accessibility and signals major confidence from a key player in the space. What does this mean for your portfolio? Next, we're diving into a brewing storm that's pitting Bitcoin purists against altcoin advocates. As companies are stuffing their balance sheets with unprecedented amounts of digital assets, a high-stakes battle is erupting over which tokens deserve a spot and why. This isn't just talk. It's playing out in the equity markets with serious capital on the line. Who's right in this war for corporate treasury space? Then, we've got crucial insights from Jefferies Financial Group on Bitcoin mining profitability. Their latest report reveals a significant drop in August, and we're breaking down exactly why this happened, looking at hash rate increases and what it means for major mining operations like MARA and IREN. Plus, we'll see how this decline correlates with Bitcoin's price action. Is mining becoming less lucrative? And finally, get ready for this. Bitcoin ETFs have been absolutely gobbling up BTC, buying a staggering 9 times more than miners have produced in just the last 5 days. This insane demand is significantly outpacing new supply and shows just how institutional appetite is reshaping the market. We'll unpack what this means for the future of Bitcoin. Stick around for all the details and then smash that like button, subscribe, and hit the notification bell so you don't miss a single update. Bitcoin could hit $750,000 in 5 years, says Pantera Capital's Dan Morehead. Pantera Capital founder Dan Morehead just dropped a bombshell prediction. Bitcoin is set to skyrocket to $750,000 within the next 5 years. This isn't just a wild guess. Morehead, with over a decade of experience, points to Bitcoin's historical trend of doubling annually and its current small fraction of global wealth as key drivers for this massive growth. He believes we're still in the early stages of a structural bull market for the digital gold. But Morehead isn't just talking about Bitcoin. He's also spearheading the launch of a new digital asset treasury company focused on Solana, aiming for a Nasdaq listing. This venture promises direct exposure to SOL, a significant advantage for retail investors who often struggle with the complexities of accessing and staking altcoins like Solana, which Morehead praises for its potential to handle billions of transactions daily. Pantera itself holds over $1 billion in Solana, highlighting their conviction. This move mirrors Pantera's past innovation, having launched the world's first Bitcoin fund when direct access was challenging, much like how ETFs have simplified Bitcoin investment today. Morehead sees this new Solana company as the next evolution in crypto accessibility, ensuring investors can capture yields often missed. The crypto community is buzzing about Morehead's bold Bitcoin forecast and the strategic move into Solana. Analysts are watching closely to see if this new treasury model unlocks significant capital for altcoins and if Bitcoin can indeed sustain its unprecedented growth trajectory. Don't go anywhere, because the battle for corporate crypto treasuries is heating up and it's getting intense. And wait until you hear how Bitcoin ETFs are absolutely dominating new supply, leaving miners in the dust. Bitcoin purists clash with altcoin advocates in corporate treasury showed a long-standing ideological war within the crypto space has escalated into a high-stakes battleground, the corporate treasury. Bitcoin maximalists, who believe Bitcoin is the only digital asset worthy of holding on a company's balance sheet, are now facing off against a growing chorus of altcoin advocates who see value in diversifying beyond BTC. This isn't just a philosophical debate anymore. As companies allocate significant capital to digital assets, the decision of which cryptocurrencies to hold is having a direct impact on equity markets. The debate centers on whether to prioritize Bitcoin's perceived security and store of value properties, or to embrace the potential for higher growth and utility offered by other blockchain protocols. Supporters of altcoins argue that limiting corporate treasuries to Bitcoin ignores the innovation and diverse use cases emerging across the crypto landscape, from decentralized finance to NFTs and beyond. Meanwhile, Bitcoin proponents emphasize its established network effect, decentralization, and scarcity as unmatched advantages, warning against the volatility and regulatory uncertainties associated with many altcoins. The market is watching closely as this conflict unfolds, with investors and analysts weighing in on the long-term implications for corporate finance and the broader digital asset ecosystem. The outcome could significantly shape which cryptocurrencies gain mainstream institutional adoption. But while corporate giants debate their holdings, the very foundation of Bitcoin mining is facing new pressures. We've got Jefferies Financial Group reporting a significant dip in mining profitability. Find out why next. Bitcoin mining profitability dips 5% in August amidst increased network competition. Miners looking to cash in on Bitcoin faced a tougher August, as profitability for mining the digital asset saw a 5% decline, according to a new report from Jefferies Financial Group. This downturn is primarily attributed to a significant increase in the network's hash rate, which represents the total computational power dedicated to mining and processing transactions. Analyst Jonathan Peterson from Jefferies noted that a hypothetical 1A mining fleet would have generated approximately $55,000 per day in revenue during August, down from about $58,000 in July. This contrasts with the roughly $44,000 generated a year prior, indicating that while profitability has decreased month over month, it remains higher year over year. The rise in hash rate directly correlates with increased competition, making it harder for individual miners to earn rewards. This heightened competition resulted in US-listed crypto mining companies collectively mining 3,573 Bitcoin in August, a slight decrease from 3,598 in July. Despite this, these companies still accounted for a significant 26% of the total Bitcoin network activity. Major players like MARA Holdings and IREN continue to lead in production, with MARA maintaining the largest hash rate among US miners. The dip in mining profitability also coincided with a notable price correction for Bitcoin itself. After reaching record highs above $124,000 in mid-August, BTC's price dipped below $110,000 by early September, further squeezing margins for miners. Despite these short-term challenges, Bitcoin has shown resilience, with its price up 7.35% over the past 12 weeks. So, mining is getting tougher, but what about the demand side? You won't believe the numbers. Get ready, because Bitcoin ETFs are buying BTC at an insane rate, far outpacing what miners can produce. Bitcoin ETFs outpace miners, buying 9x more BTC in 5 days. In a stunning display of institutional demand, Bitcoin exchange-traded funds have purchased an astounding 9 times more Bitcoin than miners produced over the past 5 days. This incredible buying spree highlights a massive surge in institutional appetite for direct Bitcoin exposure through regulated investment vehicles. The sheer volume of Bitcoin acquired by these ETFs underscores their growing influence on the market. While Bitcoin miners play a crucial role in validating transactions and securing the network by earning newly minted Bitcoin as rewards, their production rate is finite. The cryptocurrency's protocol is designed with a limited total supply and gradually decreasing mining rewards, making new supply inherently scarce. This significant imbalance between ETF purchases and miner production suggests that demand is dramatically outpacing the rate at which new Bitcoin enters the market. This trend could have substantial implications for Bitcoin's price trajectory and market dynamics, as institutional investors increasingly favor these accessible, regulated investment products. The crypto community is abuzz with the implications of this massive ETF accumulation. Analysts are closely monitoring how this sustained institutional buying pressure will impact Bitcoin's price stability and its long-term outlook as a digital store of value. And that's a wrap on today's top stories, but before you go, stick around for a lightning-fast recap and make sure you're subscribed. What a whirlwind of Bitcoin news. Pantera Capital's Dan Morehead is predicting a $750,000 Bitcoin price. A fierce battle is raging over altcoins on corporate balance sheets. Jefferies reports a dip in mining profitability, and Bitcoin ETFs are buying BTC at an unprecedented rate. Don't miss out on the next big move. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, drop a comment with your thoughts, and follow us on all social media platforms for real-time updates.